you're wondering what trades I'm in, if you're wondering what trades I'm taking, and you'd like to see exactly how I'm trading everything, you can actually follow my trading signals. If that sounds like something you're interested in, we'll share a link in the chat and you can sign up. You can sign up directly with the link or speak to a support rep if you have any questions. If you're asking, what do I trade? Pretty much everything. Indexes, ETFs, stocks, options, futures, Forex, and crypto. Thoughtful analysis, active trading. Check it out. And now, back to the show. Good morning, everybody. Happy Friday. How's everybody's slow bleed to the downside treating you? Since yesterday's high, this market has just been steadily working its way back down. Here's the S&P falling. We're seeing some red across the board again. Core PCE came out this morning. PC this morning, not awesome. So slightly higher, which was actually forecasted. So let's go to today, 8:30 a.m. news. Here's the Bloomberg calendar. You had 2.7 was the previous, which was revised higher. Forecasted for 2.7 came in 2.8. That's core PCE year over year. So slightly higher. This is going to be, this is the Fed's preferred inflation gauge. So this would be their reason to say we don't want to cut rates right now. The month over month, previous 0.3 forecasted 0.3 came in 0.4, slightly higher. Your year over year PCE 2.5, 2.5, 2.5 came in as expected for the headline PCE. Month over month, 0.3, 0.3, 0.3 came in as expected. Personal income revised lower from 0.9 to 0.7. Forecasted 0.4 came in 0.8. Personal spending down, revised worse. 0.5 was forecast, came in 0.4. So the main one would probably be your core PCE came in slightly higher. Revised higher, also came in higher than forecast. I'm not saying that's why the market is falling. I'm saying this is just settling back into where there was a pretty important support level when we had FOMC week. That support level is right around 5,600. So we held there. This was FOMC the day after. We held there. We gapped up higher over the weekend. So this week is fading. We were just shy of symmetry. We're right between the 382 and the 50 pullback zones, which makes sense. But these bears have trimmed that lead, and now we're breaking this trend line. So I think right now it's like today's pretty much directionally just straight down. We're going to see if the market has any fight left in it, like high to low for the day, and the market can find an equilibrium. Otherwise, it might be finding 5,600 today, and they'll look to see if there's a floor off of that. So the blue line that I have here, this is a bear call spread, bull put spread combo, and I'm going to see if price will stay in the middle or get there through later in the morning. So watching that trade for my morning, we've essentially just gone straight down. So, I mean, this is the last like 30 plus minutes of trading. This market has gone from 56.86 all the way down to 56.20. So we've dropped about 60 points in the last like 30 minutes. So everything's down across the board. Yeah, I'm just going to hang out and wait, taking a look at some of my other dashboards. We have volume showing declines. We have, advanced decline line is all red. So S&P is down. Advanced decline is down. Not looking too hot. But, noticing that we do have some support to the left-hand side. That's that 5,600 handle. I'd like to see price bounce off it a little bit. Volatility is going up. So if you take a look at the VIX, VIX is heading higher. It's up 8.57%. The VIX 1 day is also, somehow it's red on the day, but primary VIX 30 day is 20.28. So we're back into the 20s on the VIX. Well, are we heading back up? We're about to find out. So a couple things. I did this yesterday in my YouTube session. This would be a good chance to look at the bigger picture. Look, this tariff talk going into next week, end of the quarter. Do we have a high low that's going to provide something like this? Because if that's the case, we better hold that 5,600 floor, in my opinion. If we're going to come back to 5,600 and bounce, that's about the bulls' last chance to kind of defend that zone. Because if this is not going to hold, if it's not going to hold the 5,600 handle, then this likely drops back down to the same lows again. Is this a bear trap? Is this a slightly, oversold plus divergent bottom, and then the market comes back in and defends that 10% level? I mean, there's a couple of key spots the bears are going to have to step in and defend. So man, I should have taken that freaking butterfly. I was looking at a butterfly this morning. Let me see if I can reissue the trade here. I put it in for 50 cents. It was trading for like 35 or 40. I'm like, well, let's give me a bounce and I can maybe take the trade. Let me go up in strikes. Yeah, these are all like low deltas now, but let me see. If I pin this thing, that's 15 cents, 30 cents, 35, 55. So could we snap all the way back to 56.95? That'd be filling the gap on the day. That'd be a pretty impressive recovery if we did. I'm going to take this. I'm going to see if I can get this trade for 50 cents. Come on, man. I'm trading right at the mid price at 50 cents, trying to get filled. Open today was 56. So what's my pin price? 95. I'd be looking to get right at that gap today. Come on. 50 cents. You can do it. I have some real-time levels, 56.19. We have just been falling all morning. I don't see a lot of key levels for today outside of 5,600. If we hold here, oops. So if we hold at 5,600, that might offer a bit of a bounce in here. This is around 5,670 or so, 5,700. But if we break 5,600, this could be a lot of like delta hedging to get through these major floors, and this could be some damage. So yeah, I mean, I'd say if 5,600 holds, then there is a support level. If it doesn't hold, then I would say buckle up, and this market can have one of those nasty, nasty days. And I'm still not getting filled on my butterfly trade, you piece of crap. It's like lingering around 50 cents, 46 cents. Like, give me. We should be seeing higher implied volatility. Gosh darn it. So 95. It's like it's trading at 50 cents. Come on. I'll try it again. I'm going to go for 45. Will it fill? Will it fill? Will it fill? I don't want to go less. Dude, it's just making me chase this butterfly spread lower. Let me try one more trade here. If I go 56.85 by 90, that one I should be able to get filled on. Son of a biscuit. All right, I'm just going to let this one marinate. I'm going to go replace, set it for 50 cents, and just see if I can get that thing filled where I want it. So pending order. It's a broken wing butterfly right around today's gap. I need to see the bulls do something better than just be completely absent. This market is just steadily falling all morning. So I'm looking at a pin price right around the gap today. So if price does bounce, that's a good thing. If price goes lower, still watching that floor around 5,600. We'll see. I look at this, it's like I don't love that level. But actually, probably okay. All right, I'm gonna let that marinate. That could be a little profit trap at the end of the day. Market have to work pretty hard to get back to the highs. All right, anyway, let's do some top down. So everything's down. S&P is down. Equal weight's down 0.9 versus 1.26 on the index. So S&P index down, SPY's down. Equal weight's down a little bit less. Nasdaq down 1.67. Q's down 1.67. Dow is down 1.07. Russell down 1.6. VIX, like I said, spiking back up into the 20s again. Dollar index has been dropping as well. Let's go DXY. Dollar index here. Okay, is it time to sell the dollar? Maybe. Is it turning on the 4-hour? Not quite. I'm gonna wait for a little bit more of a pullback on the dollar. I still like this kind of 200 moving average on the 4-hour time frame. Just trying to pull back a little bit more into this inefficiency from that 3-day slide. So I'm not taking the bait on that potential trendline break. Or if I do, it's got to be, take a small trade here and then go back to either the high or the 200 moving average for a second trade. So, small trade to kind of test the trend line break, 2 to get back to these recent highs where I'd like to sell it. And I could go small trade, stop loss, probably above this structure to be safe, but just above the trend line and see if this actually does, either break and go or break and retest and then roll over. But I do like looking for a short opportunity on the dollar. Are you looking for gold sells? No. I wasn't a gold sell. I took profit on that, and now I'm just looking for pullbacks to get a gold long, which is probably a ways off. I mean, gold continues to get flows. We're at again all-time highs, I believe. Yep. So we have another all-time high in gold. Again, I think a gold sell is likely. I don't want to fight some silly, global central bank capitulation move that's like everybody is buying gold. So what do you do? I don't want to call the top. I took a trade, I took a stab, it rewarded me. I still think technically we need to have a pullback. I just don't know what's going to be the switch. Is it like a Q1? I mean, we had like a Q1 and gold is up. Do we pivot and have a little pullback because it's Q2 now? Maybe there's a seasonality look to it, but otherwise I'm not going to force a sell trade on gold. So the way that I did the sell trade earlier was I ramped it up where I had a bull call spread combined with a bear call spread, and that combined for a little profit trap. So I pulled in $1.20. I had a $5 profit trap, and my $1.20 credit, I ended up closing it out for about a 20-cent bonus credit. So I pulled in $1.40 per contract, and it was a little income trade. That was it. I did that trade. It took about a week and a half. So I'd say that's a pretty good stab. And that was before we made 2 days of pushing to all-time highs. So I'm glad that I'm out with some profit. It wasn't really threatened until we're above 32.50. But I would say right now this gold train continues to run pretty hot. And the best part is silver is also participating. So I'm looking at both of my positions. Anything that's gold and silver is still looking pretty good. So my let's see here. Which one is it? This is CEF for physical gold and silver, up $3,300. GLD up $16,000. PHYS up $3,000. SLV trades up about $50 right now. That's good. SLV is up around $17,000. So not too shabby. This SPY trade I might be closing out for profit. up 43. Max profit would be about 48 cents. I'm just going to take the profit here. This is trading close to a full credit. 95 cents. I'm going to take the profit here. 97, 96. Come on, you turds. 95. All right, closed out for 95. That was a 52-cent debit. Just closed out for 95 cents. Taking that little winner on the SPY. Watching my levels on SPX today. XSP, watching some key levels. 560 is a key level for me for these next 2 weeks. Put on some futures hedges. These are starting to look better. This is a futures hedge. It's already up 125 bucks. Copper looking good for full profit. This is out to April. I'm not really worried about copper. It's actually it's close to max profit. I think my max profit's around 170 bucks. I'm up 93% right now. And then another hedge for MES flat, but those hedges are pretty big. $985 risk. No, $881 risk for a $5,300 profit. $975 risk for a $44,000 potential profit. I'm not going to get $44,000 on ES, but it would be nice to get even, 5x or 10x would be pretty sweet. If I can get like a 5K or 10K profit out of a hedge, that'd be pretty sick if this market is going to just implode. So we'll see about that, Lee. I mean, that's the buy the rumor, sell the news. We'll find out. I mean, if the market is in angst about the Trump tariffs and this is going to get worse, I think. Look, this whole idea of Trump tariffs. I mean, the market was thinking, okay, this is uncertainty, but remember, this rotation started to happen before Trump tariffs got more vocal, right? I mean, we heard about tariffs. I mean, where the heck was DeepSeek? Where's all that nonsense, right? So we had, I'm trying to think where the DeepSeek stuff was. This was DeepSeek, this was tariffs, I think. So we had the tariff talk early in the year near the all-time highs. And then the market rolled over with that recession, or not the recession, the rotation from Mag 7. That was really the biggest driver, in my opinion, was too much concentration in too few stocks. The market needed to broaden out. To do that, the market had to decline, so it did. Right? This was all Mag 7. The fuel was more tariffs, more kind of hardball from Trump and what was coming out news-wise. And then it started to change. Like the tone changed. Like, oh, maybe it's more softer, more flexible, blah, blah, blah. The market started running with that. Well, I think this, if we're going to head lower, I don't think it's just tariffs. I think this is the market as a whole looking at downward revisions in earnings. That's what I think it is. This would be the market saying, okay, look, this growth is priced too high, and these revisions are going to come in dramatically lower, and that's going to change everything about the current valuations of the markets. So if this gets worse, it's most likely going to be fundamentally driven where earnings are just priced in way too high and they're going to be revised lower. And it's the severity of that pricing change. It's the severity of that valuation change. So if we go from, let's say that S&P multiples at 25 and all of a sudden they're like, no, they're not worth that. They're going to be priced at 20. Well, that's a big shift. And where we're sitting at all-time highs, like that could be, I mean, that could easily be a 10, 15, 20% correction in the market. I don't know. So that is why I'm braced, right? So, like I said, we're coming back down to some key levels. Let me put in another line right here. That is a support zone that I think we should be paying attention to. That was a hold level from March 18th, hold level from the 21st. And I mean, given today's price, if there are market makers doing anything today, anything at all, it'd be nice to see them stepping in somewhere to defend some key support levels. I mean, I get it. Like the market can go lower, that's fine. But to have this open up and just be straight bearish without having some type of game, like, the market goes down for the first hour. Well, how about we have a little equilibrium, right? You go from high to low. Do you have any just Fibonacci behavior? Anything, right? This high, this low, we pull back to a 38% zone, 50% zone. If the bears want to take it a chunk lower, that's fine. But I at least like to see some ebbs and flows to this movement today. So we'll keep an eye on it. If I've got price coming back into this blue zone inside of this area, then I'm hoping to grab a few bucks out of my SPX trade this morning. Any prop firm suggestions? That's probably a better question for Nick. I don't do any prop stuff with Forex or futures. I just manage accounts. So um, I don't know. Nick probably has better insight to that than I do. I know a lot of prop traders that are in futures that are using like Apex and Top Trader. Those are the two primary ones that I hear a lot from futures traders. But Forex wise, I'm not sure. I know 8cap has a good prop situation. I met with their team, not that long ago, maybe last month, and they've got they've got the nice thing is they've got deep pockets and whoever like they're partners with, but that might be for better for non-US traders versus US. I'm not sure. It's probably a non-US trade. So all right, let's go currency strength. Yen strong. That's pretty much it. Yen strong, which is going to be looking good for FXY. It's going to be looking good for 6J, which is my Japanese yen futures. But I'm not jumping back into futures yet. I'm not jumping back into Japanese yen futures. I am still holding shares of FXY, and my break even is around 59 bucks. So I'm still up a couple dollars on FXY, but looking to get obviously much higher. One thing that could be interesting for the currency land in 2025 could be perhaps the BOJ is one of the few central banks that's still raising rates. And if they raise rates while the others are falling, starting in summertime, we might have another similar kind of deleveraging event like we did last year, where there's a rate hike from the BOJ and then the Fed comes down. Just putting it out there, that June rate decision for the Fed. This probability for June, a 64% chance of a cut starting June 18th. This June-July window, I wouldn't be surprised if the Bank of Japan somehow sneaks in some type of like major summer movement, and it's probably not a good thing. So just be on the lookout for some shenanigans out of the BOJ and watch for some crazy Japanese yen price action maybe coming this summer between like this June to August window. So I would think if anything, it's probably long. It's long Japanese yen in my opinion, probably not short. So I think the JPY gets a little bit stronger. That would be adding fuel to this deleveraging event that was just like we saw last summer. So time will tell, but I'm still long for this reason. If FXY gets back to these highs, that's a nice little flip for $7 or $8 a share, and I'll probably take it. All right, I'm going to keep watching this one. Let me see just a little fib here, just for my own peace of mind. If we have a pullback, if that is the low, this is kind of grasping at straws here for intraday price action. But if we pull back like 30%, 56.40, let me put in a chart alarm there. So that's a 30% pullback intraday. And maybe even the old equilibrium, 50%, 56.64. Couple chart alarms there, see what happens, as opposed to making fresh lows. So we'll see if the market can offer up some type of pullback, and I will watch. All right, that's FXY. Let's go top down still. Dollar index. I still think the dollar is a good opportunity to sell. Case in point, euro dollar, for example. Let me do this. I'm going to scale in. I'm going to do this really small, but I'm going to scale into. I don't know. It's okay. I think the dollar index is a pretty clean trade from the euro dollar. If I took a small trade right now, so if I take a small trade on the euro dollar, that'd be trade one. I'd probably have to look for either this as a trade two or this as a trade two. So trade one would be at market, trade two on a 200 moving average or a pullback zone, and then my stop loss would be below these lows. So if I can space this out over a couple trades, risk maybe 1% here, and then see if this to the upside offers up like 1.5%, maybe 2%. I can also stack buy stop orders. If I'm right directionally, I can add more to that winning trade. So what I'm trying to do is, carefully, carefully kind of test and keep the drawdown very much in control, and then I can add to the direction once I'm a little more confident that we're going somewhere. There's room for gold to go higher. I mean, silver, absolutely. Silver, there's plenty of upside in silver, in my opinion. I think I see silver going back into the 40s again. Give it enough time, but I mean, silver to me is one of my like favorite technical plays as far as the precious metals. It's hard to say gold at all-time highs looks attractive. I know it is. I know that there's central bank buying. I know there's like this automatic bid price. I think anything that gets a decent dip is going to be bought. But silver is the poor man's gold. That's way cheaper. And the gold to silver comparison is, if we have that 2-year range that holds, I think silver gets the upper hand nod. But usually recessionary indicators probably favors gold more than silver. Silver also has a lot of industrial qualities, but technically it's just so much cheaper that I'd like to see that ratio catch up where silver looks a little bit better. Okay. All right. So I may look at this trade. I'm just trying to think like a starter trade. I think this is a fake out though, just to be honest. I mean, if I took a trade here and it's trade one and it goes my way, great. I mean, maybe it gets back to the highs again. But I've got to be prepared for if I take a trade here, it falls right back down to the 200 moving average and I either put in a second or a third position here with my stop losses below. But I think if I build this area up, this was the inefficiency I wanted to get filled kind of in this zone. And if we head back up on a weaker dollar, then great. And the DXY, it would just be going back down towards the initial breakout point, which is still pretty low. This is my big breakout level. This is the initial breakout point. This is where the market started to show those initial inefficiencies on the dollar right around 100.81. So, I mean, I could see there's a little bit more noise in here, but I could still see the dollar breaking lower. So I'm going to go ahead and position for that on the euro dollar. So if I go in for a small trade right now, so if I go trade, I'm going to take a small order here. I'll go like 50-cent pips. That should be 5,000 units. Take profit's going to be around 1150 to 1180. I'll go 1170. Stop area I'm going to be flexible on. I'm just going to trade this really small for right now, but I'm going to take a buy order at market for 50 cents. And I'm going to put another trade in around this like 106. I'll go 106.55. 106.55. I'll make this a non-FIFO and take profit at 1170. Okay, so that's going to be a pending order. Actually, you know what? Put that one in again. Limit. So 10, what I say, 106. 106.55. Take profit 1170. Yeah, I want to make sure I get my timeout here. I don't want an expiration on this trade. So go out to the end of the year. Okay. So that's trade one, trade two. So buying at market, pending order at 106, 106.55. And I'll kind of watch that area. Now, if price is going to go up, then I might cancel this trade and just manage this first trade back up to highs and take some profit with a little swing scalp. But if we go test level that comes back down to the 200 moving average, I'm just going to wait. Entry one, entry two, watch how this area behaves. This to me should be a pretty strong level of support. So if it is, then I'm looking for price to be bouncing in here. If I get a trend line break, I can start adding a bunch of buy trades in here that I like with confirmation going my way, but I'm trying to keep the drawdown, as small as possible with just a, just a couple of test levels that are small. Okay. All right. So I'm going to throw that in. That'll be in the trade alert section. So my FOREX trades, I'll take a picture of the euro dollar, new trades, euro dollar, testing. So I'm doing a buy at 108.26, and that's filled. Pending buy at 1.0655. That's pending. Watching DXY closely and liking euro dollar as the primary inverse correlation. I believe DXY can slide lower into the 101 to 100 levels. So I'm willing to test the euro dollar for small trades with long positions. And let's see if the DXY 100 area equals euro dollar 111.50 to 1200 area. Okay, so post that, copy. Okay, and I'm looking for this to be, I'll put on a little long here, and my stop area is going to be probably right below this like 105 area. We shouldn't go too much lower than that, but I'd say probably safest would be, we're making higher lows in here, right? So lows, higher lows, higher lows, higher lows. We shouldn't really come back and take out that low, but you know, if we're not cooperating at the 105 handle, then I'm going to stop out probably just below that. So that's pretty much what the reward risk looks like. Okay, so take a screenshot there, post it in the alert section. Okay, trade is in. All right, all that was just kind of a segue on dollar index. Let me keep going top down. Oil, I don't even know why I'm looking at oil. I don't like it. If I want to trade oil, I should just look at strangles. But I still don't like the trade. I think oil can break the floor. If we're going to see an improvement in energy prices in the U.S., we're probably trying to drive the prices lower. I don't know if I have really anything going on energy outside of XLE and Chevron. XLE, this trade is actually closing out, I think, on Monday. XLE positions, look at the whole portfolio here. XLE is, I just did a bunch of puts, up 420 bucks. This closes out by Monday, full expiration. I'm just going to let it expire for full credit, get 425 bucks. The other one is Chevron. Partial shares. I didn't really add a bunch to it, but I tested the levels. CVX currently up around $1,100, and this is just running CVX. You know, look, I think Chevron is more than just a oil company. I think that if we're going to have this like AI infrastructure, AI future, everything for utilities, energy, whatever, this is the big player in the space. So I took the trade basically down here when we're sitting at support. I did some bull call spreads. I did some ratio spreads. Those were for profit last year, and I kept the shares. And so I'm looking to see, will Chevron just run back up to highs? So if we get back up to like 180, then I'll probably take some profit. But if I want to see this go potentially higher, okay, fine. But I could definitely see a range trade going, right? Like a range trade here, and maybe that gives us a couple opportunities to participate. But this run so far has been pretty good. So that's it for energy plays. Oil, I'm not in oil. I think that we are still really indecisive. It's obviously going to be a bad look for inflation if oil prices go higher. It's a better look for inflation if oil prices go lower. But then you got to wonder, what is overall global demand? You know, is it dropping because U.S. is producing a ton? What about OPEC? But Saudi Arabia and U.S. both want to see lower oil prices because they have the ability to produce oil at a profit to as low as like $35 a barrel, maybe $30 a barrel. So I could see them both being okay with oil prices dropping lower, but then you start to see OPEC get a lot more vocal. All right, dollar yen so oversold. I don't know about that. Relative to what? I don't know how you can say oversold when this thing hasn't even started yet. You know, to me, dollar yen is still a massive range. I see this thing as far as the sell side. This is just getting started. I honestly like. I probably won't touch this trade because I hate the Japanese yen and currency trading. But if I'm right on the Japanese yen getting stronger, this would be a pretty fantastic trade. If we come back and revisit those August lows, or we actually have a symmetry trade, high, low, lower, high, lower, low. I'm just looking to line up a pattern here on the higher time frame and see if that's actually pushed to symmetry. That also comes back in line with the yearly moving average. So the hard part is if you're short dollar yen now, you're probably going to be going through a lot of chop before this thing officially like rolls over. So this is what I'm saying. Watch that summer stuff. There could be some shenanigans from like June, July, August on the Japanese yen, where if this starts to happen, we know how quickly it can happen. And who knows? But if I'm right on this directionally, there will be some opportunities to be, just honestly, some of the best trades I've had in the Japanese yen they've been sell stops, right? Like I sell, it fills, I sell again, it fills, I sell again, it fills, and it just bear flags its way all the way down to the profit target, and you get zero pullbacks, but you can just stop selling. This thing goes like a falling knife down to your profit target. So anyway, I'm definitely not that interested on a 45-minute chart there, Dougie. But bigger picture, I like this kind of 155 zone for resistance, bigger slide down. I mean, I like lining up Forex trades where I'm looking at like 500 to 1,000 pips open space. So that's more for me. All right. COR. These are my non-US things. Let's see what SEHY is doing. Choppy. Let's go to the DAX. DAX pulling back a little bit. This big rip out of Eurozone, big rip out of China right away, starting to stall a little bit. FEZ, same thing. I'll probably still add some more premium in this one if it pulls back enough. FTSE still choppy and sideways. Argentina pulling back, trying to find a 200 moving average move here. China also fading a little bit off those September highs. Well, I should say September highs to fresh highs we had in March. EWZ is Brazil, fading off that 200 moving average. I want to see Brazil get above the 200 moving average, and I think we get a good position to go long. ILF is Latin America, same thing as Brazil. Want to see it get above this 200 moving average. MAG 7 all the way back down to the lows. Pretty close to it. So MAGs having the toughest go. Now, here's an interesting spot for MAGs. If we're getting back down to this swing from high to low, we did pull back just shy of the 30%. It is very possible that MAGs goes down to this low again and then bounces. So when you see a swing that goes back to a 30% retracement, a lot of times that 30% will just hit the same low again and then pull back. And it's either going to be a bear flag or perhaps it pulls back into the deeper retracement zone. So we might see the MAGs bounce off this level again, and we might be in for some more kind of roller coaster rides in the equities markets. There's still monster stocks. Obviously, if you go Apple, it's still a $3 trillion company. Amazon, still a $2 trillion company. Broadcom, it's given back the $1 trillion mark, and this handle is not looking good. So Broadcom has room to fall. I'm totally good with this actually falling. This would be in your kind of chip space, semiconductor space, AI space. Let me see what fair market value is on Broadcom. AVGO. Let's go here. So price to earnings, that's pretty expensive on price to earnings. Let's see what it is compared to the peers. Fair value at 200. Well, then get cheaper. If I'm going to look at it enticing buy, I want to see this thing way, way, way cheaper. Compared to its peers, AMD is more expensive. ARM Holdings more expensive. NVIDIA, probably not awful. Qualcomm, a little bit cheaper, but AVGO working at bow. Well, unless we see a move back up above the 200 moving average, I would be willing to say, okay, that looks like a long position. But if it's going to fall, then let's talk about this low or this yearly moving average. Let's see what the percentages look like. And from this correction, that'd be about a 50% correction. So we pull back to this is a 5-period yearly moving average. Yeah, I'd love to see some, $140, $125 price targets with a fair market value at $200. Sure, I'd be interested in Broadcom at that. Google, sliding as well. Just have some dollar cost averages in. I still have some positions on Google 155. We're trading at 157. I might end up taking some shares of old Google, maybe. Not yet, but to be determined. 150 is my line. So if we get to 150 or lower, then I take some potential assignment. If we have, we have strong support back here in September. That's a 150 handle, 148 handle. But I've got some trades out to Google for the year. Meta coming back down to the 200 moving average. I'm interested in Meta with a much lower low. So high, low. Maybe if it gives me a bullish pattern that I can start reestablishing longs. But if this is going to be high, low, lower, high, lower, low, lower, high, lower, low, then I'm just going to wait for a trend line. Remember, in 2022, this stock was down 76%. So don't for a second think that a little 20% pullback is enough on a pullback like this. This could be a 50, 60, 70% pullback. If we're going to see a 2022 all over again, then you've got growth and momentum in tech that could be really, really tough. So I'm not touching these stocks. I think there's way more volatility than people are ready for. And that is why I decided I'm trading indexes mostly. I'm riding this thing out. I've got a lot of hedges on. So I'm going to do my best to kind of defend my my bottom line. It's like I don't want to take a lot of heat if this market's going to dump. I'm trying to put on hedges right now that are going to pay net profit. That's the plan. Microsoft, this one is profit. This one is profit. I'm still looking one for April. Let me check in this one right now. So April is not that far out. Currently, they're flat right now. 370 is the level that I need to watch. 370. We're trading at 382. It's only 20 days away, so that may actually work out okay for a ratio spread to give me some max profit, unless we are going to drop aggressively lower. So I'm going to change this to a 370 alert. So 370 would be my ratio spread assignment level, and I'll keep an eye on that one. Okay, Netflix. I've got a broken wing butterfly up above these highs for an April 17 expiration. That one's looking good for full profit. That should be in here. Netflix pulled in 74 cents. It's break even, but need a little bit more time. Only 20 days left. I also have a $5 profit trap. And I mean, Netflix has to get back to all-time highs for this trade to be a threat. But also, there's a $5 profit trap on top of the 74 cents that I pulled in. So this one closed out for profit. That was full profit last week. That was a nice little winner. Nvidia trading at 109. I don't know. Just expect a lot of chop on Nvidia. I mean, if it's going to be resilient, it's still priced pretty well. It's relatively cheap for the fundamental valuations. So if we go Nvidia, it's still fair value at like 130, 140 bucks, I believe. 126. We're trading at 109. So it's going to be choppy. But would it overshoot? I mean, if we come back to like $100, we come back to $80, $90. Okay, but I still think that this area, would maybe give us a building zone, watch some accumulation, and then Nvidia at some point probably comes back to retest highs. I think my outlook on going gangbusters bullish on Nvidia is done. Now it becomes a structural trade for me, right? So we've broken this trend line. We've got lows to watch for. We've got previous highs to become support. We've got a range opportunity. So if we're down here at a pretty attractive level, that's, let's say $20, $30 below fair market value, I can see the price coming back to the halfway point. That's your halfway point. I can come back to resistance and support. So there's levels to buy. There's levels to take profit. There's profit opportunities. As we come into these lows, I'm probably going to sell more premium. So I've taken a lot of profit on Nvidia with these ratio spreads. I still have some when the price was really dropping and IV was high, I sold a bunch of puts at the 75 and 70 handle. So that's pretty much what my Nvidia looks like right now. Nvidia, I have some shares with some collar trades, and then I just sold a bunch of puts. 75 and 70 puts, 75s and 70s, 75s and 70s, lots of puts and combos. So so far Nvidia is looking pretty good. The shares are not. I mean, I'm down in shares. I've got the collar trade running. My $100 put out to May is in profit, but I'm going to see if it really really dumps. Because if that's the case, then I'll take some profit on the puts and lower my cost basis. Okay, Tesla 263. So I have a covered call Tesla next Friday. I had one out last week. I could have let it go for a full repair at like $1,700. I rolled it out for a week to grab another $2.55. So my Tesla break even is around 229 or so, maybe even cheaper than that right now. So Tesla, let me go to my tracker here. Tesla is break even. Willing to own. Okay, watching. Let me just find it's in my spreadsheet here. There it is. Okay, break even is 227.08. 227.08. The lows were 217. So, if we stay above 247.50 by next week, I'll grab about $2,000 on 3 accounts. So I'll have about $6,000 in Tesla profits. If we stay above 247, if we don't, then I'll just continue to chip away at it with covered calls. But we'll see how this one plays out. There's a gap fill there. I understand it. It may not be above my strike, but so far it's kind of hanging in there. We'll see what the resiliency is for Tesla. What up, dude? What up, dude? And yeah, so that's next week, 247.50. Berkshire Hathaway. You know what? Let me price something in on Berkshire Hathaway. I hate to be the bear. Let me see if I can go Berkshire Hathaway B. What the heck? Berkshire. There it is. BRK. We're trading at a 45 IV. So this one has a similar bar count to the S&P. The S&P has already made that move. We're now 354 bars away, and we have a decent stretched 12.5% away from the 200 moving average. That stretch was around 15%. This stretch was around 15%. This stretch was probably about the same, around 15, 16%. This stretch is around 18%. Okay. So what I'm going to look for is, could I set up a trade on Berkshire where I can pull in credit? I can allow this to go up a little bit higher, but as long as we are, getting some sell levels in around this 20% spacing. So as long as I'm selling something around like the 555 or 560 level, let me see if I can price this thing out. So if I go trade on Berkshire Hathaway, we've got earnings coming on May 2nd. Okay. So I either go out 28 days and I get little to no premium for this one. Let's see what this one looks like. So this would be if I did a call, ugh. This one's not terrible, but it's not great either. No. I was looking at a similar trade to what I did in gold. $5 profit trap, probability of profits pretty high. But that trade for 37 cents is kind of bogus. So I'm probably not going to take that trade. If I do a bear call spread, $1.24 on a bear call spread, that's not the worst case scenario. Could I do that's 83 cents, 10 wide. Man, that's just a terrible reward to risk profile. All right, it's just not offering enough premium. I don't love it. Now, I could go through earnings and kind of take a stand and say, I think it's going to, fall through May. It's like, maybe it does. But if I went out to like the May 16th one, which is post earnings, the risk that I run is if there's another pop to the upside, it could threaten my position. So let me just see what prices out. 49 days is kind of a sweet spot expiration. So let me go May 16th, price out a similar trade. So if I went let's say 550, 555, 560, like that trade I can get behind. But now my probability of profit's only 84%. I don't love that trade. Move this down a little bit to increase the probability of profit. $1.52, 86% chance of profit. But that's a lot of buy power, and there's no defined risk on the trade. So probably not the smartest trade, which means I'm probably not going to take it. So yeah, I think I'll hold off. I look, if I put in a trade hypothetically, I don't think that we're going to get to 550 or 560 without having some type of pullback. So that's what I'm trying to line up. I just don't have a good setup to have a fair reward to risk on the trade. For me to risk unlimited amounts of upside because I don't have anything braced on the calls, then cool, I grabbed the dollar, but I have like thousands and thousands of dollars of risk if I'm wrong. So I don't want to take that trade. Especially if we have some type of seasonality where this April 2nd Liberation Day tariff conversation is in fact a buy the rumor sell the news and the market lifts up, then Berkshire can go to new highs again and I'm just going to be in the way. So if we have any seasonality to these markets, I want to be careful of like calling the tops in some of these trades. I still think there's a high bar count. Same thing on gold. I still think we're going to pull back, but my job is not to call that. So this trade is done for profit. That was ratio spread for last week. That's done. But anyway, that's it. Bonds, anything here? Bonds up a little bit. TLT's up to 90, still working part of my diagonal spread. Fed funds rate, nothing really changed. Nothing shifted. 10-year is falling a little bit. That's totally fine. If the market's going to fall, I said this for the last couple of weeks. If the 10-year is going to get lower, I think the market's going to have to go with it. The only way we're going to see the 10-year really drop substantially, and what's stupid is this is the first time in history that the yields have done the exact opposite of the Fed, because the Fed cut rates right in here and the market said, haha, we're going to do the exact opposite. And we ripped up about 115 basis points. And then the market falls, and so does the 10-year. So if the market falls again, well, that's how the 10-year falls. This is possibly a little bit more encouraging for borrowers. The problem is you're probably going to see like a 15 to 20% correction on the market from all-time highs. So that's a pretty interesting trade-off. Would you rather see mortgages fall down by 50 basis points or 100 basis points and also see the potential threat of recession? Or would you rather see the 10-year stay sticky and, slow growth and choke it out where nothing can really grow? I don't know. So I did have this conversation yesterday, and I think this is something important to look back on. But if you go to 1998, this was kind of a similar political environment and similar kind of economic cycle where we go into, this is 2022. I've obviously go back a lot further on the weekly chart. I'm running an entire class on this stuff this weekend. So go back to 1998. Doesn't really look like much because you're like, well, the market crashed in 2000. Sure. But in 1998, I thought this was a really interesting comparison to where we're at right now. Intra year, we had a high in July, and by October, this market was down 22%. But by the end of the year, it was actually back up to the highs again. That is a crazy, crazy move. That's the type of garbage I could see this market doing in 2025. We have this fall, pullback, fall. The market has this nasty, nasty cleanse. And then we have just an absolute ripper of a market for the next maybe year and a half to 2 years. So if there's pain coming, I'm telling you, like, be prepared for like a 20+% correction. If it exceeds that, I'd say 20 to 30%. 30% is going to feel like absolute garbage unless you're hedged, which I am. But I would be looking to sell a ton of premium at the 20 to 25 to 30% correction levels. And I would not look back. I would be willing to put on most of my cash and deploy, because if we do have a recovery, even back to the highs again, that is, a 22% correction. A 22% correction right here. If it gets back to those same highs, that correction goes, 28% to the upside, almost 29%. So anyway, if something like that occurs, that is why I'm hedged. If we find the bottom at whatever level that might be, 20, 25, 30%, and we get back to those highs, that to me is a great time to be looking to get long. And how to do that? Selling a lot out of the money puts, collecting a bunch of premium, and then of course, like stacking up some directional trades, kind of week to week, month to month, as this market might find that it needs to cleanse itself first. And then there's swift policy adjustments and reform. It could be on the fiscal and monetary policy side. But that's probably my biggest macro thought for 2025 is if we have a nasty slide, it's probably going to come with a bottom at some point, but it's going to be really, really disruptive. But as we've seen in years past, it's like, man, if you buy the dip in this market, it somehow just makes you a ton of money. So a dip, a correction, I could see it being here. Somewhere in here. So if there's an overshoot, I still look for a bull pattern. I can then position out that bull pattern, but I'm braced and hedged for this. If we get it, I probably have 5 to 10x returns in a lot of my hedges, which will help offset hopefully a lot of the potential drawdowns exposure, because I've spent so much time these last couple of weeks just fighting back and limiting some of the exposure. I've added about $470,000 in buying power back in the last couple of weeks. So I did clean up a lot of positions, took a lot of winners, and I still have some exposure, obviously, but it's a lot. I feel like I'm a lot better positioned now than what I was like going into that first fall. So we shall see. And at the same time, let me keep this really simple before I bounce out of here today. So if we go back and just think about the bottom in 2020, I'll just go from here. Okay. So from this COVID low, let's say we have a wave structure. Okay. Just basic Elliott wave stuff. If we go wave 1, 2, 3, 4, 5. Okay. And then after wave 5, we typically see an ABC correction that gets us back to this level or this level before the market resumes its trend. Okay. Now I see this from the COVID low 1, 2, 3. So we are looking at a wave 4 right now, and wave 4s can be really tricky because wave 4s can either be a correction wave where it pulls back and tests. This would be your swing high from this wave 1. So if we have this being resistance becoming support, then that would be your wave 4 correction, and then a wave 5 is still to be determined, right? But also I see a lot of wave 4s, and this happens in currencies quite a bit. When you have a big swing in your wave 4, everyone's looking to short wave 4 when you really shouldn't. Wave 4 is just a correction, and then wave 5 typically just kind of comes out and finishes. Wave 5 is usually a bit slower than waves 3. Waves 1 and 3 are usually fast. Wave 5 is kind of this like slow grind, but still making higher highs and higher lows. But wave 4 is mostly a pause type correction wave. And if we're dealing with that, that's going to be a bunch of noise we're trying to navigate right now until this wave 5 can kind of pick up steam. But I think, right now, given the fact that we've had this overextended move, plus the correction, plus the rotation, plus all the potential uncertainties, yeah, maybe this becomes more of a corrective wave, and then we see this level. So just eye on the prize, bigger picture talking, resistance becoming support, anything around like 5,000, anything around 4,800. If we hit those levels, I'm extremely interested in positioning longer term for a revisit to the highs and possibly all-time highs. So if that would be a 25% run to even 30 to 30, I mean whatever. If it takes a year or two to get that, you can analyze those gains plus leverage it with options and make a ton of money. But you got to be prepared for that downturn, which if we get it, I want to be prepared for it. If we don't get it, then I'll be pleasantly surprised that the market's not as bad. But if we get it, I certainly don't want to be feeling the pain like most investors do. So that's why I'm hedged. That's why I'm protecting the portfolio, trading the bottom line, and see if I can actually come out net positive on a drawdown, as well as have the cash to position myself for a big potential move back up. So, all right, that's that. XSP crossing. Okay, fine. Watching that for April 4th, which is next Friday. We'll see what happens. SPY's at 558, XSP 560, futures. What a nasty Friday, man. What a nasty Friday. Here is the level I'm watching for today. So I need to see if SPX can get back above this level today. Hopefully it can. That fib is slightly off, so I'm going to go just down to that low today. And this second level, this is the support level from FOMC week. So if the market comes here and then finishes, the day kind of pulling back, that's fine. If it's above this level, greater than this level, I still make money on my SPX trades this morning. I didn't get filled on my butterfly. I just have a bear call spread up here. That's fine, but I want to see if it stays above this blue line. Okay. All right. Doug is asking, what's hedging? Well, basically, if I was long a portfolio, so let's say that I'm buying the SPY. Well, if I'm long the SPY, that's where I am only going to make money if the price goes up. So what I do is I have positions on that if the price were to drop, I can make money on this drop, which will help me effectively lower my cost basis. That allows me to stay in the market. So if the market goes up and down, I can basically be flat with my P&L. And that way, if the market goes back up again, I can build that into higher highs, and it doesn't require the market to make new directional highs. So this year's been a pretty satisfactory hedge so far. I was hedged pretty aggressively in this first part of the year. I went out to Q1. So in December and January, I put on a bunch of 331 expirations. And what happened? Well, by March 10th or 11th, we had a 10+% correction. So all those played out really nicely. I had anywhere between 150 to 300+% gains on some of those hedges, and that helped me eliminate some of the trouble that I was in. And then as the market pulled back, I had a lot of winning trades, and so I closed out a bunch of those, closed out my hedges, and that helped me. So even this little push right here, this little tiny push, I was at all-time highs with my portfolio for the year, and I was up about 8% or so for the year. Right when we started out, I was sitting about 8% positive. We had this drawdown, and then we had this little push right here. I was back up to 9% in my portfolio. So that's good. Like I basically have shifted my cost basis, my entire portfolio down to a decent correction zone. Now I still want to be braced for more downside just in case, but if the market finds a way to go higher, then this 9%, hopefully getting back to highs again, I'd be up 12, 13, 14%, if not more. So hedging is just ways to protect your portfolio. Okay. All right. Anyway. All right. I'll let you go for today. Happy Friday. Let's see how the things kind of settle in for the day. I'm watching obviously closely on SPX to see what happens by close. And then Monday's end of quarter. There is a key level on SPX. JP Morgan does about a 20 delta put, 20 delta call combo every quarter. And that 20 delta is sitting around 55.65. So I do see the market capable of defending that zone and still kind of bouncing off of that by Q1, which is Monday's close. So I could see us pulling back a little bit, but then we come into first week of April. We have non-farm payroll. We've got Trump's talks on the 2nd for tariffs. It's going to be a volatile week. I don't know what direction it's going to go. I will try to trade accordingly. So brace for more downside, yes, but trying to be somewhat optimistic that this market can not just roll over on itself and the bulls just go in hibernation. So just be prepared. It could be a very ugly first half of the year. Yeah, if we are going lower, I could see this market for the first half of the year being 15 to 20% down. It's going to scare every investor, and then everyone's going to miss out when this market starts ripping back up to highs again in the next 6 to 12 months after that. So just saying, have the mindset of cash at the ready, play defensively right now, and look for the big opportunity. The bigger picture opportunity is I see this as if we come back to this 2021, 2022 high, that is a beautiful spot to be looking to get long. Now, if there's, what would make it more troubling? I don't know. Maybe we go into like a nasty recession and all of a sudden this is not just a 20% correction, but it's a dead cat bounce. And then it's another slide lower. And we're talking about, like awful, like awful lows. But if this is resistance to offer support, if we have a bear trap here and then a bull pattern, that bull pattern could offer up some really good confirmation. But I'm genuinely concerned if you connect these lows and we break this structure. If we don't have a bullish pattern poking back up in here, that's bad. Like that's real bad. So who knows? But we're talking great financial crisis. If we have a 48% correction to find this outer trend line, the whole world's going into a recession. The U.S. doesn't just drop 48% and like, oh, Germany's fine and China's fine and everyone else is fine. Non-U.S. is fine. No, everyone's going to be down. So we'll see. Right now, the good thing is you have some optimism out of Europe. You got some optimism out of China. Whether it's optimism or you're just seeing fiscal policy spending, that's a big difference. But I don't think the U.S. can necessarily afford to go into recession. I think the U.S. still has a Fed put, Trump put backstop. There's tools to work, right? Great financial crisis. I'm pretty sure if the lesson learned is how not to let that happen again, that's why the Fed is so important to this kind of emergency backstop stuff, because they can always they can dial up or dial down the monetary policy, whether or not it's the right thing. Everyone complains it's backwards, it's reactionary, but the fact of the matter is every major dip and pullback we've had, there's been some type of activity from either government or Fed to help kind of right the ship. And whether you call that manipulation or not, it doesn't matter. If I can make money doing it, then I'll follow the Fed or I'll follow the government. I'll follow the big flows, but we got to watch for key levels. So, all right. Talking through it. All right. Have a good weekend. Thanks. Bye.
Thanks for watching today's A1 Trading Show. Be sure to subscribe and to turn on notifications so you don't miss the next one. Want more from A1 Trading? Check out the links in the description below, or our website a1trading.com. We have lots of free trading tools and channels available for you. We hope you have a great rest of your day, and we'll see you tomorrow.